Good afternoon to our webinar attendees, and thank you for joining us. I'm Ashley Willis from Fish Tank PR. We represent Seismic in its media relations program. Today, I'm going to be an impartial questioner as we cover our stated topic, investing like the pros, adding VC to your portfolio for performance, diversification, and tax benefits. For those of you watching the clock, we've allocated about a half hour to cover the topic at hand. There is a chance we'll get through it a little bit faster. So if you can stay till the end, we'd love that. And we'll try to end a little bit early as well, as we want to be cognizant of everyone's time. So let's get started. Today, I'm on the Zoom with Stephen Weinstein, CEO of Seismic Capital. Hello and welcome, Stephen.
Hi, Ashley. It's good to be here with you. Before we get started, just one quick note. There are four of us who founded Seismic: Eric White, Alice Newhouser, Jan Duran, and me. We decided we'll take turns on our webinars instead of all appearing each time. I drew the lucky straw today. So yeah, let's get started.
Yes, you did. I know we'll be hearing from Alice, Eric, and Jan in future webinars as well. So I want to start off by talking about venture investing in general and about how Seismic's approach to investing differs from the older, more traditional venture firms. So let's begin with a definition. According to Wikipedia, venture capital is a form of private equity financing that is provided by venture capital firms or funds to startups, early stage and emerging companies that have been deemed to have high growth potential or which have demonstrated high growth. So let me ask you, does that square with your approach at Seismic?
Yeah, that's about right. Venture capital has outperformed just about every other market sector because if you get it right, the returns can be enormous. Obviously, people have heard about the millions of dollars that early investors made from companies like Apple or Google or Facebook. But it's not just the big outliers either. From the latest information we were able to find via the database PitchBook, venture investments delivered an internal rate of return of just under 20%, 19.8 in the first quarter of 2021. It was better than buyout funds, better than growth funds, better than real estate. Some people are comfortable with real estate, but in terms of returns, comparable number there is a mere 5.4%. One other thing about venture is that, as far as we know, Seismic is the first company that allows regular people to invest in venture. We'll talk about that some more in a minute, but I want to make the point that we're the first up and running that lets people in for a minimum of $1,000.
Yeah, and you've talked, and I was just going to say, you've talked about some of those returns, and they're really quite impressive, and we're seeing more and more from various publications about those returns. So why isn't everyone jumping in on this bandwagon?
Well, investing in venture has definitely driven the returns that we've seen for college endowments, family offices, many institutional investors. And one big reason that, let's call them regular people, haven't been able to be involved is because of the way the investing community is structured. Smaller investors just don't have access. Turns out it's just a function of math. Venture investments typically structured as funds. Funds have a cap on the number of investors they can bring in. So if the cap is like 100, which it is in many cases, and you want to raise $50 million, your average ticket needs to be $500,000. As a practical matter, most venture funds raise much more money than $50 million. So their typical investor needs to have $1 million, 10 million, even more, just to join the party. I don't know about you, Ashley, or many of our attendees today, but I don't have a spare $1 million just to throw into a single investment.
No, I certainly do not have a spare $1 million to invest. So that begs
not yet,
the question.
Anyway.
Yeah, not yet. So how is it then that Seismic has made its share available to investors who do have, say, a spare $1,000 set aside or $5,000 instead of those really big numbers that you just mentioned?
Well, what we're doing is a first. When Eric and I started Seismic, we didn't want just to make more money for rich people. We talked to, 30 or more law firms, And in their funds practices, they all told us what I said before. If you want to have a fund, you can only have 100 investors. And we kept saying, that's not what we want. Finally, we were able to find a smart lawyer who helped us crack the code. We created a special structure. It took months and months and months, almost a year, to convince the SEC that what we wanted to do was something that they could allow. But the gist of it is that we can have large number of investors, unlike other venture funds. And as a result, we don't have to turn small investors away. We call it democratized capital. With that as a backdrop, if it's okay to you, I'd like to go back to your question about Seismic's approach.
Yeah, absolutely. And I'm so glad you said that, because I wanted to get you back on track with that. And especially as you just mentioned, democratized capital and that being a part of Seismic's approach. Can you elaborate a bit more there?
Yeah, there were a handful of things we wanted to achieve when we started Seismic. At the capital raising end, we wanted to make venture investing available to the general public. We've done that. The technology is available to us now to support us. In the old days, just maintaining the share rosters and communicating with even a small number of investors or limited partners was a full-time job for somebody on the staff. Now, our investors can sign up online, be qualified by our broker-dealer online, monitor their holdings online, and we can communicate with all of them with just the push of a button. That takes care of step one. Next, on the investing side, we're dealing with early stage companies. Excuse me, some of them are still figuring out 100% of everything when we first see them. How to run a payroll, how to launch a product, what's their product going to be, who's going to buy it, and so forth. Early on, even before we formed the company, we commissioned a study of tens of thousands of early stage companies, and we found that a key obstacle to building a company was the task of running the company in the first place. So we set up Seismic to take over most of the administrative headaches, HR, benefits, legal, accounting, office space, and so forth that new companies face. We know how to do those things. And if we do them, our companies can focus on the things that matter: developing technology, building product, acquiring customers. This is a backdrop. When it's time to exit an investment, we know our companies will be ready. The books and records will be ready. Your company presentations will be ready. And whether it's an IPO, whether it's a management buyout or a merger, sometimes the biggest obstacle is getting ready. This is one of the things that we've built into Seismic. Our companies will be ready.
That's great. So it sounds like you've really thought about having that foundation in place to make sure that your startups are successful. But I think one thing that we're all thinking about is, how do you go about picking the companies in the first place?
Good question. The reason Eric and I pursued starting Seismic in the first place was that we were seeing tremendous companies with great promise. And while we could afford to fund one or two of them ourselves out of our own pockets, we needed more capacity than we had available. We've looked at more than 200 companies since we started Seismic. We've got the first handful ready to go. We'll start announcing those transactions soon. Before you ask another question, let me make a point about this. It's easy to find companies that you fall in love with. People have great ideas that just seem so probable. We recognize that. And we also recognize we need to protect our money and our investors' money. So once a company seems like a good bet for us, we run it through 3 levels of due diligence: corporate and industry, technology. We're particularly concerned about patents and patent infringement, and personnel. We want to protect our investors and ourselves from making a stupid mistake. Will we make mistakes? Sure. Will we try to do everything we can to avoid them? You bet.
Great. So we've talked about how you will identify these companies. So now, you've selected the companies, you've now invested in a company. Then what? What happens next?
Well, then we help it grow. We provide it with capital to make it happen. We surround it with our advisor team. We open doors. We ask questions like, are you sure? What if? How about? And it's our capital commitment that's unique and critical. Most companies, venture companies, are aiming toward milestones when they can raise their next round of capital. It's a distraction, and many times they run out of money before they hit the milestone. Our companies can concentrate on doing what they need to do because they know the capital will be there when they need it. At the bottom line, that's how we and our investors make money. We do everything we can to make our companies successful. Then when we sell, hopefully there's a big profit that all the holders of our shares can participate in. Also, as the value of our companies goes up, we expect the share price will go up too.
That's great. And there's two other topics I wanted to touch on today: diversification and tax benefits. We hear a lot about having a diverse investment strategy. And how does an investment in Seismic ensure diversification? Are there any tax benefits?
Wow, there's a lot in that question. Yes, it's generally accepted that a diversified investment strategy is a sound idea. When people invest in Seismic, they're buying into a diversified portfolio as we assemble it. Our companies range from gaming to fintech to medtech to general tech to process improvement. Will they all turn into unicorns, young companies with billion-dollar valuations? Probably not. Will some of them produce excellent returns? We certainly expect so. We have to keep our eye out for trends. What's popular today? What's going to affect change in 12 or 24 or 36 months? For instance, one sector we like is medtech. There you can spot a trend that wasn't so popular before the pandemic, but sure is now, and that's telemedicine. For me, living in LA with my doctor on the other side of town, no matter how efficient I am, I have to account for the likelihood of traffic on the way there, the likelihood the doctor will be late, and the likelihood that I'll be stuck in traffic on the way back. With telemedicine, I log on, wait while I'm working at my desk for my doctor to show up. We have our session, I'm done. The pandemic has definitely changed the dynamics here, and doctors have had to join the world of HIPAA-protected video. Life changes, trends change. Our job is to stay on top of that and try to see the future. We're looking for apps that will cross the bridge from in-person only to online only. Those water cooler conversations that we used to have, that quick, can I ask you a question? These need to be translated into today's world where being in the office all the time just won't be happening again. And as the pandemic diminishes, won't be online only anymore either. So as we balance the trends, the likelihood of success of each company, the amount of capital we'll need to deploy, we also need to keep our eye on how we exit our investors so our investors can make money. Let me try that again. We keep our eye on how we exit our investments so our investors can make money. With a single investment in Seismic, our investors expect to have a lot of diversification. And as we increase the value of individual Seismic companies, other companies in the portfolio can expect to rise with the tide. I think you asked me about tax benefits also. Our shares are what are known as qualified small business stock. The tax advantage is that if you hold your shares for 5 years or more, when you sell them, most people don't have to pay federal capital gains taxes. That's a big savings. No one else offers that in the venture world. If we make a distribution along the way, we sell a company and we have profits to distribute, that will be taxable. But the eventual sale of your shares, if you sell them, that's protected. Now, we don't give tax advice, so our viewers should consult their tax advisors for more information on this. Sure. Lastly, I want to make a point about fees that I think we need to note. I'm not aware of any venture fund that doesn't charge fees to its investors. That's how venture operators make money. They charge fees for asset management, usually 2% of the funds they control every year. That comes right out of the investors' pockets. Then they charge 20% carry, where 20% of the earnings goes to the managers. And sometimes there are fees for all kinds of other things, closing a deal, selling a company, putting together a financing. So that 19.8% annualized IRR that I mentioned earlier, that's after all those fees get paid. We tried to, and I think we were successful, reimagine how the managers get compensated. Everyone at Seismic owns the same class of shares that our investors have. That means if the company makes money, everyone makes money. We recognize that our investors are putting their trust in us. Why would we treat ourselves better than our sponsors?
Great. Yeah, I'm happy you touched on fees. I think that's something a lot of our attendees were questioning as well. So thank you for bringing that up. We do actually have a few questions from our webinar attendees that I would love to spend some time. Yeah, I'd love to spend some time asking you, Stephen. So let me ask you the first question here. Do you invest in a particular industry like enterprise software, or is it a case-by-case basis? If it's the latter, how do you ensure that you have the expertise on hand?
I think we covered that when we talked about how we balance our portfolio and how we create a diversified strategy. If a company fits into that strategy for what they're doing, where they are, who they're run by, what kind of money can we make, how much capital do we have to deploy, we'll obviously take a look at it. We have a lot of expertise on hand, from our advisors to our due diligence teams, where we look at corporate, industry, technology personnel. If we need more expertise beyond what we have on hand, either we'll figure out how to get it or we won't make the investment.
Our next question from our attendees: when you sell a company or it goes public, what will you do with the money? Will it be distributed?
Our intention is to distribute as much and as often as makes sense. I would like to see all our investors have their initial principal returned as quickly as possible. We'll have to balance the ongoing needs of the company against the future investment needs, against our desire to do right by our investors. It's the same balance that established profitable companies face every day.
Okay, and then I do believe we have time for one more question. Are there any plans in motion or talks with potential companies going on right now?
Oh, good question. We have 14 companies named in our offering circular. Most of them are very viable options for us. I think it's safe to say we'll be making some announcements very soon.
Very exciting. Okay, great. So I do want to be cognizant of everyone's time here today, so we will end there. We are going to leave the chat open for another couple of minutes to take questions so that we can answer them later, either by posting responses on our offering page, which is invest.seismic.company, or by emailing you directly. If you come up with a question later, you can always email us at invest@seismic.company. That's .company, not .com. And we'll notify everyone by email when our answers are up on the website. And we'll also post a replay of the webinar so you can watch it again at your leisure. So thank you again, everyone, for joining us. Thank you, Stephen.
Thank you, Ashley.
Has a great day.
It's been a lot of fun. Thanks, everyone.